Good evening, everyone, and welcome to our webinar today. From overcrowded trades to diversification, building resilient portfolios with ETFs. I'm Belito from CGS International. I'm the head of retail research, and I will be briefing you on some of the global macro updates today before I pass the time to Hazel. Hazel is the chief trainer at the Joyful Investor. For those of you joining us for the first time, I think this is the third session that we have already. So we have this session together with Joyful Investor on a quarterly basis, where we talk about some of the latest topics about the market. So today we'll be focusing a bit more on the ETF. So just a bit of background. Hazel, you want to just say hi so that people know?
Hi guys, Hazel here today.
Yeah. All right. So over the past few years, investors have been rewarded for concentrating on a relatively small group of markets leaders, particularly large tech and AI related names. Now, but as market leadership begins to rotate, relying too heavily on yesterday's winners sometimes could leave a portfolio a bit more vulnerable than expected. We've seen how volatile the market can be, right? If you look at how some of the tech stocks have gone up sharply as well as came down quite a fair bit. So you can see that it can be a bit volatile for your overall portfolio, right? So tonight we will look at where momentum is moving globally and in Singapore, as well as why the AI opportunity is broadening beyond semiconductor companies and how ETFs can provide a more diversified and disciplined way to participate. All right. So the session will start off. I'll start off with a bit of a global and a bit of how the Singapore market is and why we need to look at ETF before I pass the time to Hazel to explain a bit more on how to invest or build your resilient portfolio with ETF. But before we start, let me just briefly highlight the important disclaimer. All right. So basically, this is just this is just a general information and education purpose. All right. If you want to take any investment advice, do talk to your financial advisors, right? Because your investment goal and as well as your time horizon could be quite different from what we are talking about. All right, so I'll start off with a bit of global views before I pass the time to Hazel. All right. So basically, if you look at the market right now, the global market momentum is really rotating. We've seen AI hardware semiconductors have done very well at the start of the year, right? But of course, we've seen that rotation a bit right now. And then we think that leadership is changing because some of the earnings momentum have been proven, especially by some of the hyperscalers. So just give a bit of context at the end of July, as of then, the S&P 500 remained positively 9.9% year to date. But if you look at Russell 2000, which is probably the smaller caps, have jumped up by about 17.7%, right? In July month itself, the Nasdaq 100, which is composed of most of the tech names, have dropped by about 4.8%, right? So the idea is that, this is not really a sharp bear market. There are basically three key takeaways from this. Firstly, is that the broad bull market that we've seen, the structure remains intact. But of course, the leadership are starting to change, right? Investors are looking at names that are probably at a better valuation, as well as those that have seen a bit of change in terms of the narrative. Semiconductor names have done exceedingly well at the start of the year, have seen a sharp pullback, right? But of course, we've seen a rebound, I think, just about a week ago. So that volatility is expected to sort of continue at least in the near term, right? So selectivity becomes even more important, right, in this market. And so where we see some of the, if you look at just from a momentum perspective, if you look at it, these are basically, I'm gonna classify them into three buckets, right? The first one is the structural leaders. Second one are those that are coming out with stronger momentum, and of course those that in terms of the momentum has started to fade off quite a fair bit. So if you look at structural leaders, includes your energy, your cloud hyperscalers, selected industrials, and of course AI infrastructures. I think we talked about that for a long time. The AI investment capex cycle is going to be a multi-year cycle that we're looking into. So we do think that these are structural leaders. Of course, if you look at, they are also in the fading momentum basket. Some of them, like your semicon names, for example. Basically, what we are saying is that sort of volatility that you expect to see going forward as well. So those are starting to show a bit of momentum. Is your financials, your healthcare, and those data center real estate that have not done so well at the start of the year. So we are seeing quite a bit of that changes for a fair bit, right? So the practical lesson here is really that to sort of follow earning supported momentum, right? Not just basically chasing after stocks that have the strongest momentum in terms of share prices and all that, right? So when there's, just give an example, Microsoft as an example, we've seen a sharp pullback at the start of the year and everything. But their latest earnings shows that what we've always talked about, that on earnings, I think we do think that the company is probably one of those best positioned to monetize AI, and it is starting to show that. So we have seen a sharp rebound on that front. All right. Now, so but we don't think that the AI trade has ended. It's just that it's moving beyond chips, like I mentioned. Before this, at the start of the year, it's probably your chips, your server, your semiconductor, but now we're looking at more those that are involved in power, cooling, data centers, and enterprise AI. So there's a bit of change on that front. Now, looking a bit more closer to our region market, I know there are Malaysian and Singapore clients here, so just going to talk about, but focus a bit more on Singapore because Singapore has done exceedingly well at the start of the year, until now actually, right? So they are basically the regional momentum leaders. If you look at but one of the key thing to take note is that the rally is increasingly concentrated, right? What I'm trying to say is that if you look at the STI has done very very well, right? But if you compare that with the small cap, it's actually far exceeded. Even if you look at it compared with the SG Next 50, right? So you've seen the market leaders have basically done very well. We do think that that momentum remains attractive, but the index strength does not really equal the broad market strength that we are seeing, right? So that's something to take note of. Now, if you look at the next one, basically where the momentum is really concentrated on, if you look at it, is your structural leaders like your banks, mainly your SGX, your OCBC, DBS, they've done very well. There are selective opportunities like the likes of UOB. So I think UOB has actually rebounded quite a fair bit recently. So those are things that you want to look at. Some of the REITs as well. Things that are a bit more on a more cautious tone includes your tech, your telecommunications, those that are probably and REITs that have a bit more leverage compared to the rest. So those are probably areas that we see a bit more weakness. Now, before I pass the time to Hazel, I'm just going to talk a bit on some thematics, which I want to explain why I want to highlight this so that you know why you want to look into ETF. So, for example, we do think that the next bottleneck in the AI space is power and cooling. So, just to let you guys know in terms of the demand, right? So, the traditional rack need about 10 to 20 kilowatt, and you look at the difference in terms of the requirement for power is about 50x times, right? So, the demand for data centers is about I think in terms of electrical, thermal, software, and services markets, as well as your cooling, you can see the numbers there, right? And I think if you follow some of the commentary by, for example, Jensen Huang, they do talk about the requirement, the big needs for plumbing, electricity, and stuff like that. So those are areas that you really wanted to look into, right? So this is probably where the next bottlenecks that we are looking into. But just to give of context, these are also not cheap names, all right? So for example, you can see some of the global AI power and cooling investment maps, some of the names here. So these are those that are involved in core power platforms, high growth cooling. So these are some of the names that you can look into. But year to date numbers have also been very, very strong, meaning they've gone up quite a fair bit if you look at the numbers, right? So for example, Bloom Energy has more than doubled, right? So that's basically where the risk is because valuation is on a high side. And then, of course, the lead time could be longer than expected. There's also the hyperscaler capex risk and all that. Which brings me to my next slide, which I want to talk about why we wanted to look at ETF because we do think that ETF provide you with that discipline, especially in a market that rotates quite quickly and with a lot of volatility. So we can see that leadership is rotating quite quickly and quite volatilely, right? You look at the market, it's not just a fair bit of movement. The movement is significant. I think SKNX the other day jumped up by 30% after some good news from the earnings and of course the guidance by the hyperscalers. So these are areas to take note of. So volatility do raise that single stock risk, and of course, breadth is also very uneven, and of course, to time the market is exceedingly difficult, right? Like I mentioned, the next bottleneck we're looking at is probably power and cooling, but you look at the share price, a lot of them has already went up quite a fair bit. So this is where ETF really can come in here to help you in terms of diversification, lower the single name risk. It's easier to look into it, especially for retail investors that do not have so much access to live data as well. So we do think that that provide you a very good way to invest without having to rely on a perfect or good stock selection. Right now, with that, I'm going to pass the time to Hazel. Hazel probably explain a bit more on the ETF front. Hazel, over
Thank
to
you,
you.
Billy. Thank you. Let me share my slides first. Okay, let's just do a quick check. Can you guys see my slides clearly? If you can, just help me type a yes in the chat box. You can see my slides clearly on the screen. Okay, thank you. Thank you, Jeff, Angeline. All right, thank you. So if any one of you have any problem, just let us know along the way. Right, so Billy gave a very great starting on how the markets have been like in the recent weeks and months. There has indeed been a lot of volatilities happening. So with all of these volatilities, with global markets, some parts of the markets at record highs, like here in Singapore, while some other parts, say in the US and South Korea, you have a lot of volatilities, geopolitical tensions, and so on. I would like to understand firstly, what are all of your biggest concern when it comes to investing right now at this juncture? Okay, so what I've done is I've listed out a few choices that I can think of at this point in time. So help me by typing in the chat box number 1 to 5. Which are the ones that you are most concerned about? Is it about Singapore market being too high? Thinking that is it too late to invest, or are you worried that what if I buy and then the market crashes, or you are worried about number 3, geopolitical uncertainties affecting the oil prices and inflation? Is AI a bubble, or simply I just don't know what to invest in? Can you help me type in the chat box 1 to 5? You can choose more than one if you like to. What are some of your biggest concerns, right? So let's find out what are all of your biggest concerns. Okay, 4 is AI in a bubble. Okay, from Billy. Um, okay, I see 2 and 4. So 2 is market crashes. Okay, 4 is AI is a bubble. 3 is geopolitical tensions. Okay, a lot of 2. 1 also. Okay, is it too late to invest in Singapore market? Okay, so quite a mixture. Yeah, it's quite spread out quite evenly. Um, a lot of you guys have mentioned about the AI bubble. What if also the market crashes after I invest in it? Then how my portfolio would see drawdowns, right? And so on. Okay. So and what I would like to tell you is that, yes, there's a lot of uncertainties right now. Sometimes you look at things like geopolitical tensions in the Middle East, US, you look at AI, you're worried whether it's a bubble, or some of you are just probably thinking, I don't even know where to begin, honestly. And I think this is exactly why investing, can feel overwhelming at times, because there's always something happening in the market that gives us a reason to hesitate or to wait first and see how. Okay, so that's why tonight, right, what I want to cover today is more on this thing called ETFs, right, exchange traded funds, because we want to see, how can ETFs actually help us, right, to build a more diversified portfolio across different kind of markets, across different asset classes, so that your portfolio is not just positioned to only benefit from one trend or one theme. All right. Okay, but before I dive deeper into that, just allow me to do a very quick introduction of myself first, because some of you maybe you didn't manage to attend the previous 2 webinars. So we had done 2 other webinars in the first quarter, second quarter of this year together with Billy as well. So for those of you who are joining us here for the first time today, again, my name is Hazel, right? I'm the co-founder and chief trainer of the Joyful Investors. So I spend a lot of my time showing people, how to navigate the world of investing, because there is just so much noise out there. Every other day, you're going to see a hot stock, a new prediction, a new headline on what to buy, what to invest in it, right? So these are sometimes, or in fact, a lot of times, it could be noises out there. So what I want to do is to really cut through those of noises, so that, investors, you don't invest just based on news, based on headlines, but you really know what to look out for. Like, for example, earlier on, Billy mentioned about Microsoft. And in fact, I believe at the start of the year, probably the first webinar or so, we also actually talked about Microsoft very briefly. And at that time, the share price were actually still very much underperforming. So it depends not just only on headlines, but really on the underlying fundamentals, the earnings, how well the business is doing, the competitive strength and advantage that the company has, right? So these are the things that myself, I've been teaching through some of the webinars, workshops, in-person workshops, courses, and so on, right? Now, but of course, aside from classroom setting, you will also see me bring education outside of classroom, sometimes on radio shows, sometimes at SGX events, investment fairs, or even overseas, right? We have investment talks, or even in our universities locally and overseas as well, right? And I'm also a trainer with SGX, with SIAS, with ISCA Academy as well for their investor education program, right? So that's a quick introduction of myself, so that those of you who are seeing me for the first time, you know who I am and where I come from, and what I do in this journey, right? Okay, so again, the same disclaimer, right? What I'm going to share with you today is not for, it's not to tell you what to buy, what not to buy. So it's not a financial recommendation, but rather it's about the thought process of how the framework can be like when it comes to building your portfolio using ETFs, right? Okay, so how do I invest when the market is giving me very mixed signals, right? That is the question. Because if you look at STI, we have hit all-time high again, right? So now we are looking at breaking above 5,600 points, and this is a level that the index has never seen before. So those of you, if right now you are investing in the Singapore markets, you have Singapore stocks in your portfolio, you probably have been feeling very good about your portfolio recently, right? But at the same time, in other parts of the world, like if you look at US, we still see the geopolitical tensions that continue to linger. And we also have semiconductor stocks and the AI, the tech part of the world that is driving a lot of what happens in Asia, right? With Taiwan, Korea, especially going through very wild price swings. In fact, if you look at names like SK Hynix, Samsung, they have been going through very volatile daily price movement. So their daily price movement can sometimes be more than 10%. Right, it could be up more than 10%, down more than 10%. So this is what I mean by really volatile. Okay, so this brings us back to the question earlier on that I talk about, right? If markets now, some parts are at record high, some parts we have geopolitical tension, some parts we have extreme volatility like AI, semiconductor. How do we invest without having to worry about whether we have made the wrong decision, right? So this is where we have to bring ETFs in, right? So for anyone of you who is newer to investing, or if you are new to ETF, exchange traded fund, basically it's just a basket of investments that you can buy. So you buy one single investment, right? But you don't only own one company. You own, say, 20 different companies, 30 different companies, right? So with one ETF, you have that instant diversification. So today, instead of asking which is that one company that's going to win, when you invest in an ETF, you are not asking about that kind of question anymore because you are trying to gain exposure to a broader group of companies together. Now, but I wanted to make it really clear that ETF is not like a magic shield against losses. Okay. Some people they thought that hey, if I buy ETF, my whole portfolio is just ETF, then wow, my portfolio will never see any drawdown. Okay, that's not true. If the market falls, the ETF prices can also fall. Okay, because ETF is just a basket of the company. So if the company is inside the ETF perform badly, so can the ETF prices too as well. Okay, but it does help us to solve the problem of diversification. And on top of that, very importantly, it removes the emotional trap. Right. What do I mean by that? Because psychologically, a lot of people, when they see share price drop, sometimes the brain will immediately just panic and then you want to just sell off everything. But when you invest in an ETF, the good thing is that because it's a basket of companies, right? So even if we have bad news from one single company, it could have limited impact on the overall ETF price, right? So in other words, it becomes psychologically easier for you to hold that investment through the volatilities. So you don't need to be the smartest investor in the room. You just need to be the one who can invest consistently the next 10, 20 years from now. So with ETFs, that can make this journey easier for some investors. Okay. Now, so these are the very common benefits of ETFs. So those of you who have already invested in ETFs, have been investing for some years, you probably have already heard about all these benefits, right? But the bigger question or the bigger problem that investors face is now. So I know that ETFs sound useful, okay? Maybe I can start looking at ETF, but then there are so many ETFs. If you go and search for ETFs, just go and do a Google search, ask your AI tool, ChatGPT, Claude, Gemini. Suddenly you will realize, wow, there's hundreds of ETFs, thousands of ETFs, right? So where do we begin, right? How do we start building that ETF portfolio? So how do I know which one to look at and so on, right? So what I'm going to do next is I'm going to start off with looking at the SGX market first. Okay, I'm going to dive deeper into the SGX market because here is something that a lot of people don't realize, and that is that when we are talking about SGX market, we are not talking about only Singapore companies. So some people thought that, hey, if I invest in the SGX market, it means I'm only buying Singapore companies, but that is not true. In fact, if you take a look at this chart over here, what you will see very interestingly is that you can also invest in ETFs that give you exposure to overseas companies as well. Okay, so when you say SGX listed ETFs, what I'm saying is not just Singapore companies. What I'm saying is that is a gateway where, yeah, I'm trading on Singapore Exchange, but yes, I'm trading in Singapore dollars in many cases, but the exposure could be other parts of the world. Okay, so let's map out this ecosystem properly together. Okay, so you see that there are different axes, right? So on one side, right, the vertical side, what you see are the asset classes. So we have equities, meaning to say shares of companies. You have fixed income, things like bonds, right, which is more income focused, usually more stable, but of course not always. And we also have things like your REITs, right, which REITs will give you the exposure to the income producing real estate properties. And then we'll also have gold ETFs as well that some investors, they will use it as a diversifier. Now, on the other side, you have the geographical focus, meaning to say some of the ETFs give us exposure to Singapore market, some of them give us exposure to China, but it's not just about Singapore and China only. I also want exposure to other parts of the world, so that's why we also have another group, the regional or the global. Okay, so this is very powerful because it means that with just a handful of ETFs, you can now build genuine diversification across companies, across countries, across asset types as well. I don't need to hold 30 different companies, 50 different companies, but I can do it through ETFs. All right, so feel free to take a screenshot of this slide if you like to, because this is a very comprehensive and very good categorization of the ETFs that we have listed on the Singapore Stock Exchange. All right, so I'm going to walk you through a few of these ETFs that we have here listed on this slide, and they come from different buckets, of course, so that you can see exactly how it actually works. Now, let's start off with the one that probably we are more familiar with, okay? So the first one is called Straits Times Index ETF. And we actually have two different ETFs from two different asset management company. One of them is ES3 ETF. The other one is the G3B, okay? So STI, I know that it has recently been making a lot of headlines. People are saying, STI reaching all-time highs, new all-time highs. So many investors, when you're looking at ETF, you might be thinking, okay, so if Singapore stocks are doing well, then maybe I should buy the STI ETF. Now, so before you jump right straight into it, what I want to like you to know is that before you invest in any ETF, the first step that you must always do is go and check out what are the underlying holdings inside the ETF. Okay, what is really inside this ETF? So like in this case, what is inside ES3? You can see the screenshot on the left. These are the companies, right? The top 10 holdings inside ES3. And the screenshot on the right, slightly smaller, but those are the top 10 holdings under the G3B ETF in this case. Okay. So this were taken, as of late of July last month. So what you notice is that DBS, OCBC, and UOB together, if you go and sum up this number, 28%, 18%, 10%, you will see that these three banks represent approximately 57% of the ETF holdings. So yes, if you buy ES3 today or you buy G3B today, while you are getting exposure to 30 companies, but also bear in mind that the composition, the weightage is very different. So it's not equal weightage by company. So what does this mean for you? It means to say that if the three banks continue to do well because of favorable interest rates, good earnings, then yes, the STI ETF share price more likely to do well. Okay, not confirmed, but more likely to do well because more than 50% comes from the bank. Okay, so they already have a very strong control over the price of STI. Okay, but conversely, if today the bank earnings come under pressure, then it will also put a drag on the STI ETF price disproportionately. So this is something that we have to know because I wouldn't say it's dangerous or it's an opportunity because it can work both way, right? If the banks do well, then yes, you will see better price rally for the ETF. But if the bank is under pressure, then the ETF share price will also be under pressure as well. But the danger comes in that a lot of people who just invest in the broad market indices ETF, right? They would think, okay, today I buy this two ETFs, then I'm very diversified across Singapore. Yes, you are diversified in a way, but you will realize you are also making a concentrated bet on the Singapore banks, whether you realize it or not. Okay, so take a look at the holdings before you dive into investing in any of these ETFs. And where can you find the holdings information from? Very easy. They will all be listed on the various asset management company. They will list down the ETF and what are the top 10 holdings, and this will be updated timely from time to time, right? Now, so aside from STI, if you look at SGX market, we also do have the REITs ETF, okay? They are listed. So there are more than this two, but I'm just using this two as a very quick example. So on the left, what you see is the SRT ETF, CSOP IHS REIT Leaders Index ETF, and the one on the right is the Lion Philippe S3 ETF. The ticker is CLR ETF. Now, and again, these are the top 10 holdings that I took off from their respective asset management pages. So it's important again to look at the holdings. There could be overlaps, but you will see that the percentages will also, it might not be the same always. In this case, how come these two different ETF, although they give me exposure to Singapore REITs, but then they have different weightage, right? And you can see that the names, right, the ranking are also different. It's because the underlying index that they track is actually different. So one of them tracks the Morningstar Singapore REIT Yield Focus Index. The other one is the IHS REIT Leaders Index. That's why it could be a little bit different. Now, in general, right now at this point in time, if you're looking at Singapore REITs ETFs, they are generally offering yields in the region of somewhere between 5% to 6%, right? So when you invest in the REIT, right, what you're getting to the exposure is the exposure to the physical assets, like your offices, like a shopping malls, okay, or logistics properties, data centers as well. So these are the properties that will generate rental, and then this rental will get distributed down to investors. All right. So 5 to 6% yield, okay, generally is higher than the inflation rate that we are seeing right now here in Singapore, which is something that, of course, we want to have, because when you invest in whatever asset class, at the end of the day, what you want to do is minimally you want to beat inflation. Okay, that is the foundation. And then, of course, aside from beating inflation, you want to also build wealth through this investment. So that's why when we are looking at the yields, right, it only makes sense that it is able to beat inflation. Then it's something that you want to be looking at, right? Now, aside from REIT ETFs, we also have China tech ETFs that are listed on SGX. One example is this HST ETF, which actually tracks the Hang Seng Tech Index. So, what is Hang Seng Tech Index? It is the 30, okay, the index tracks the 30 largest tech and internet companies that's listed in Hong Kong. So if you want to understand, okay, what are some of the names, then you look at this top 10 holdings. Okay, so these are the top 10 holdings. Now, in general, I would say that for this HST ETF, it gives us a mixture of both the hard tech and soft tech, but you do see quite a good number of soft tech names inside. Okay, soft tech means to say what? Soft tech refers to companies like your internet companies, like Alibaba, like Tencent, what else? Meituan. These are more of the soft tech side. Okay, soft tech means that the companies they are focusing more on scalable digital solutions, user experience, right? Hard tech, on the other hand, is about things like your semiconductor. So yes, there are some chip related companies inside here as well, but I would say mainly more of the soft tech side, although it does give you some exposure to the hard tech using this HST ETF. Okay, now if you want to look at hard tech example, then this is the ETF, SCY ETF. It gives us exposure to the hard tech side of China. So it tracks the underlying index, which is the CSI Star and Chinex 50 index, that gives us access to 50 largest innovation and tech companies across China's star market and the Chinex board. So hard tech, if you look at the names, a lot of all this, either they are semiconductor companies, or they could be, for example, CATL, right? So it's the EV battery maker. So these are more of the hard tech side. So we're looking at things like chips that we use for our smartphone, for our data centers, EV batteries in the cars, robotics, and so on. So SCY ETF generally gives us more of the hard tech exposure for China. Okay, so if you look at ETFs like HST, or if you look at ETFs like SCY, what I'd like to share with you is that for this kind of ETFs, usually investors may consider using them as part of their satellite portfolio or part of the tactical portfolio. Now, I explain later on in the next few slides on what I mean by this. Okay, in other words, the portfolio, the part of your portfolio that can go through bigger swings, whether it's on the upside or downside, of course. Okay, so bigger swings in general. Okay, and also another ETF that a lot of you might not know is that we can actually invest in the US market through the ETF that's listed on SGX through this ETF called S27. Okay, this ETF is actually exactly the same as it gives us the same exposure to the 500 largest company in the US. So the underlying index that it tracks is the S&P 500 index. Okay, now but at this juncture, some of you might be wondering, hey, if there's already so many ETFs that's listed in the US, why do I want to consider, buying this ETF that's listed on the SGX for what? Okay, now there are different kind of practical reasons sometimes. Let me share with you, what is the benefit or the practical considerations of why we can also consider having SGX listed ETFs as part of our portfolio construction. Now, firstly, of course, is you are able to transact in SGD because for myself, okay, I come from Singapore, I live and earn in Singapore, so this process is more convenient, right? And of course, in terms of the currency stability for SGD. Now, aside from that, is being able to trade in the Singapore trading hours, right? So you don't necessarily need to wake up late at night when the US market is open to place your order transaction. And of course, the third reason for those of you who are living in Singapore, you will know about this thing called SRS, right? Supplementary Retirement Scheme. So all the SGX listed ETFs are actually SRS compatible. So today, if I want to get certain tax benefits, right, and I want to top up to my SRS, I want to use the money inside SRS to go and invest, then it gives me more choices to look at. I can consider ETFs that gives me exposure not just only to Singapore markets, either to US market, China markets, or other parts of the world as well. So this is the practical considerations of why we would even want to consider Singapore listed ETFs in the first place, when I know that in the US market, there's so much more. There's thousands of ETFs listed in the US market. Okay, so this is for the Singapore listed ETF site. Now, let me move over to the US listed ETF market. Okay, so I'm not saying that, if I stay in Singapore, then I don't care about US listed ETF market. That's not true. Okay, now there are many excellent US listed ETFs as well, and they can be very helpful for our portfolio construction. But for the US listed ETF market, unfortunately, I cannot give you a very nice chart like what you see for the SGX listed site, because why? In US, we have over 5,000 different ETFs as listed. So I cannot break down or have a summary table like what I did for the SGX listed one. Okay, but basically, the way that you can understand the US listed ETF market is this. Firstly, we have this category that is the broad market indices. Broad market means to say what? They track a broad index. For example, in US, the main index that we always look at is S&P 500. Just like in Singapore, we have the SDI, all right? Also, we have the NASDAQ 100, okay? And then there are also ETF like VTI that give you the total stock market exposure. So ETFs, there are those that give you the broad market exposure. So it's highly diversified, okay, for most of the time. Now, but if you don't want to be so diversified, you want to just get exposure to a specific sector, yes, you also can. All right, because in the US market, there are actually 11 sectors. So they have a categorization system. So they categorize it into 11 sectors. So for example, if you want to gain exposure to healthcare, then you have ETFs like XLV. Of course, the names that you see here is not exhaustive. Okay, there are other names also. So XLV gives us exposure to healthcare. The XLK, for example, gives us exposure to the technology companies. All right. Then aside from looking at sector specific, what if I want to just focus on a specific theme? So it goes down even further. Yes, you can as well because there are also different kind of ETFs. Like for example, this AIQ ETF here, it gives us the exposure to the companies that are highly related to artificial intelligence. And then if you want to look at say cybersecurity, for example, there are ETFs like this BUG, CIBR as well for cybersecurity exposure. If you want say semiconductor, right, you have names like SMH. If you want to look at cloud computing, you have names like SKYY, and so on, or clean energy, ICLN. So, in other words, they actually have many of all these products that track a very specific theme that allows investors to be very flexible with building up your investment portfolio. All right. Now, but one important point that you must know is that the more specific the ETF becomes, the more important it is that you need to understand the concentration, the underlying holdings, and whether there's any overlap between multiple ETFs that you own in your portfolio. Because if let's say you are buying a broad market ETF like QQQ, take for example, okay, you will be buying hundreds of companies, right? Or for example, SPY, okay, you will be buying the 500 companies that is operating in various sectors, various industries. But if let's say you are looking at a semiconductor ETF, then now I'm buying a smaller group of companies. But if I buy, say, a semiconductor ETF like this SMH over here, let me just draw it out. This one over here. Then what if I also invest in say AIQ? Then there could be some overlaps because some of the semiconductor companies could also be inside here as well. All right. So that's what I mean by if you go down to all these specific themes, you have to be careful. Sometimes there could be overlap in similar names. So you could be having higher allocation to some names than what you might realize. All right. Okay, so these are the different kind of ETFs that we have in the US market, in a single market as well. Now the next question that we want to answer is, okay, so now I understand ETFs, right? There's so many different kind of ETFs, but how do I actually put all of them together into a portfolio? And this is where I would like to introduce to you this concept of having a core portfolio plus a tactical portfolio. All right. So core portfolio means what? Core portfolio means you want to see as like a foundation. So generally, when we are talking about core portfolio, we are looking at, say, at least 80% or more. So most of the time, 80% or more of my capital will be inside the core portfolio. Okay, so for this core portfolio, usually what I want to do is I want it to be very diversified. Okay, so it is diversified across different countries, across region. I could be looking at also dividend paying stocks as well, income producing assets like not dividend stocks, but dividend ETFs, REIT ETFs as well. So it is diversified. It can give me both the income exposure and also the growth exposure. Now, for your core portfolio is where you want to more passively manage it. So it's not about having very exciting investment ideas inside the core portfolio. No. If you want to have exciting investment ideas, you can keep it to your tactical portfolio. All right. So don't need the full portfolio to have the most exciting investment idea at this point in time. Core portfolio is to give you that peace of mind, right? Whereas tactical is usually, maximum about 20% possibly of your portfolio where you want to be more opportunistic. So I want to focus on certain themes, okay, that I think is important in the future. But at the same time, I want to limit my risk. So I don't want to put too much of my capital into those themes. So for example, let's say today, if you have a very strong view on semiconductor, or if you have a very strong view on China technology, then I will look at, okay, this ETF that gives me that exposure, but I'll put inside the tactical side. All right. So it's important to think about position sizing as well, so that you are diversified, whether is it within the core or within the tactical portfolio, right? So the whole point is I have something that is more stable, the foundation, but at the same time, I have something that gives me a little bit more excitement. It could drive certain growth. I want to write on certain themes or trends that I think are secular trends over time, all right? Now, so before I bring everything together to do a quick summary of that, previously, prior to this webinar, we actually received a couple of questions that the team has actually collected. And I've actually put out some of these questions that some of you guys actually sent in. And one of the questions was asking, how do we actually select suitable ETF in the current global market trend? How do we allocate funds to different type of ETFs? Meaning, like each ETF, what is the percentage that I need to have? Okay, now, some of you at this juncture, you might also be having similar questions like this on your mind as well. But I would like to tell you that, I cannot give you a guide on what is the percentage and so on because it's not like you are studying in school last time, studying math, studying science. There is only one answer. But when it comes to investing, right, there is no one answer only. It really depends on each investor profile. So some of the factors that you have to think about, I've actually listed them here. Firstly is you have to think about what is your investment goal? So I didn't talk about this in this webinar, but you have to always think about, are you looking at income, growth, or are you looking at both, right? Because that will depend on what kind of ETF. So how do I know it's suitable or not? Suitable or not depends on your goal. If today I want to look at income, then I go and buy an ETF that gives me growth, then obviously it's not suitable. Then it's wrong already in the first place. It is not say wrong, but it's inappropriate. Okay. So you have to ask yourself what's your investment goal. Secondly, is what is your conviction? What do I mean by this? Let's say if I have very strong conviction in, say, cloud computing, because I see it as a long-term secular trend. It's not a short-term hype only, it's a long-term trend. Then this conviction, because I have this strong conviction, then possibly cloud computing ETF could form part of my core portfolio. Now, but on the other hand, for someone who don't believe in cloud computing, but they think that, okay, in the short term, because of AI, I think it will benefit, and then I might be able to make money from it, then it could be like a tactical play. So part of a tactical portfolio. So you see the same investment can be placed in different part of your portfolio. It depends on your conviction as well, whether you believe in the long-term investment thesis of that, right? So construct core plus tactical. Usually core is more diversified, and then tactical could be certain parts. Let's say, certain AI plays that you think you want to tap on for opportunities in the short term. Okay. Now, another very good question that is raised up is this. Someone asked whether DCA method is suitable for ETF, and if yes, which ETF is suitable. Now, this question is very good because why? A lot of people, if you go through the videos online on YouTube, articles, and so on, they will always tell you, okay, the way to invest for an investor, whether you are new season, just do DCA for ETF and that's it. Now, but today I want to bring a contrarian point of view and I want to tell you that DCA works only for some ETFs, not for all ETFs. What kind of ETFs can work? ETFs, they are on long-term uptrend. Then it makes sense to DCA because when you DCA, your cost, right? In the future, the share price will always go up, right? Because of that, so when you DCA, no matter it's high or low, over long term, I don't need to worry because the share price go up. Okay, but if you are doing DCA for cyclical ETFs, that means ETFs whereby the share price is going up, down, big ups and down, then it is not appropriate because it doesn't make sense. I'm just buying high, low sometimes, but I don't have that long term price appreciation to support it. Then over time, sometimes I could be in the green, sometimes I could be in the red, right? So this is actually a very good question that's raised by one of you guys submitted before the webinar. Okay, but if you have other questions, just feel free to also send them into the Q&A chat box. Later on, we will also cover together with Billy as well. Okay, before I pass over the time, right, just want to do a very quick summary of what I've gone through so far today. So this is the 4-step ETF portfolio check that you can look at for yourself. So feel free to take a screenshot if you'd like to. Basically, firstly is before you jump into any ETF, look at the holdings first. At least look at the top 10 holdings because top 10 holdings are very important. Their weightage is usually a bigger chunk, right? So what are under the top 10 holdings? Secondly, is how diversified am I really when I put this ETF into the portfolio? Don't just count by the number of ETFs. Some people always like to ask, how many ETFs should I have in my portfolio? You don't just look at how many ETFs you have, you look at the underlying. If I have 10 ETFs, but they are all they are all giving me exposure to semiconductor, to AI theme. Then am I really diversified? No, I'm not really diversified. All right. Thirdly, what is my core and what is my tactical portfolio? You don't need the entire portfolio to be exciting. All right. You need to have the foundation for your core as well, so that over time you can still build wealth sustainably. And finally, can you stick with this strategy? Can you really stick with this strategy? And I think this is the most important question, because volatilities is something that's here to stay in the markets. With AI theme right now, it can get even more volatile, just like you take a look at what's happening in South Korea as well. So you need to have a portfolio whereby you can continue to invest not just for 1 year, 2 year, but over the next 10, 20 years, even when the market gets volatile, right? Okay, now before I pass it over, just want to do a quick sharing. If you'd like to follow us for more investing insights, you can actually scan this QR code to actually follow us on our various social media platform for the joyful investors. We are on Instagram, YouTube, Telegram, TikTok as well. So these are some of the channels that we are more active on. And also, if you want to learn beyond just webinar, you want to see me in person also, through my in-person coaching sessions, we actually do have the following upcoming sessions. These are the dates all the way till the end of this year. All right. There's no session in December because I guess all of you guys would be flying off, for your holidays and so on. Okay, so you can scan this QR code over here and sign up for any of the respective sessions that you would like to join us in. We do have sessions that cover on REITs. Okay, we also have sessions that cover on just general investing, especially good for those of you who are new to investing, or you have been facing problem in investing, hurdles in investing. And we also have session that touch on technical analysis, so stock charts. That will be in October. Okay, so I will now then pass the time over to Alia first before we look at some of the Q&A questions that you guys have.
Thank you, Hazel. Hi, everyone. So, again, before I start, my name is Alia. I'm part of CGS Up Singapore, and I'll be giving you just a little bit introduction about our platform. And then, meanwhile, you can still send the question on the question box. I just need a little bit of your time. Just give me a second. I'll be sharing my screen. Okay, so I'm Alia. Again, this is our platform, which is up. We do have the platform in Malaysia and Singapore, but I'm coming from Singapore side. So about our platform, we are very intuitive platform. You can check your portfolio at glance and streamline buying and selling of the stock, and easy market access and price alerts. You can set your price alerts. So for Singapore, we do cover Singapore Exchange, Bursa market, and US market. But for Malaysia, don't worry. It will be coming soon because I understand there's quite a bit of Malaysia of our client from Malaysia as well in this our webinars. And then we do have 4 type of order type, which is at buy at a limit price, buy in currency, and buy in quantity, and then save up. As Hazel mentioned about DCA as well, we are able to do that in our Save Up, which is the regular saving plans. And then and then we do have a discovery section as well. So you can, there's a learning part in our discovery page, and then you can also have saved your stocks or the ETFs you've been eyeing on. And then we do have a little bit of basic of investing as well. And then this is a QR code for Singapore and Malaysia platform. And then you can contact me and email me for any Singapore inquiry. And then you can also message or email Hazim Nazri for Malaysia platform. Thank you so much. That will be all from me.
Thank you, Alia. Thank you, Hazel. Right, that's a very good presentation that you have. It's quite comprehensive, actually. But to talk about the excitement, I was thinking of SpaceX just now.
Oh,
Okay, I think we have some questions here.
yes.
But before we answer this question, I think there's another question that was submitted,
Mm,
never addressed earlier. I think it's on some of the ETFs that they're asking about. I think one of these is on the US Treasury bonds with maturities above 20 years. I think TLT and TBF. I think another one is the inverse exposure to the 20-year US Treasury lah. So I guess that one it really depends a lot on the yield. I think the present environment is more difficult for long duration bonds because the Fed has held its policy rate at the same level in July, and of course, inflation, government borrowing and long-term bond supply remain market concern. So that's probably something to watch out for. In terms of gold, I think the GLDM is basically a portfolio diversifier, the way I see it. I think that the two other ETF that they asked about is also on gold lah. So I guess it really depends on how long term you're looking at. I always see gold as probably as something that you just add into your portfolio to diversify a bit, So I don't have a view in terms of the short term momentum where gold is going to go. But so far this year it has been weakening quite a fair bit already lah. The last one is on the VO, which is the S&P 500. I think it's basically on the 500 largest US companies. I think that's a very good start for any investors who have not started investing, and you want the exposure into US market. I think that will give you a good start in terms of how you want to start off your investment journey. That will probably give you something to look into. All right, so that's basically answer the questions that we have received prior to the webinar. I think we have some questions.
mm.
First one. Examples of cyclical ETF. Do you want to share on that?
Sure. Yeah. Thanks for the question. I think it's a great question. Yeah. So Singapore REITs, in my view, I would see as more of under the cyclical side because especially when looking at properties, property market can be cyclical because of the demand and supply. So yes, that is an example. So if you look at the share price, usually one very distinct characteristics is that you go and compare. Maybe you can use S&P 500 as an example. So earlier on we talked about VOO, right? So VOO ETF. Let's say you look at the last 10, 20 years versus another ETF. Because for VOO, what you will see is a very nice uptrend, right? But if it's cyclical, it wouldn't be a nice uptrend like this. There will be lots of ups and downs. Another example that I think is very good for you to understand is if you take a look at this ETF called XLE, so the energy sector ETF in the US. Again, that one is very cyclical as well. You can look at the same 10, 20 years period and you compare it against, say, VOO ETF. You will see one is long-term nice uptrend, the other one is cyclical. Yeah, so that's how you can actually see for yourself. Just look at the stock chart. You will see that the price movement tends to be bigger on the upside, on the downside as well.
Yeah, I think it really depends a lot on the nature of the business that you're looking into. So REITs ETF is basically like a sector that you're looking into. So even like if you want to invest in say the memory chips over there, those are cyclical business. Say consumer staples, less cyclical, right? So S&P 500 because it's comprises of business of different sectors,
Mm.
so less. So basically that's how you look into it. All right. Any liquidity concern in investing ETF? So in general, I think ETF is relatively quite easy to trade. I don't think there's a lot of risk on that front, but you do probably want to look at the bid-ask spread. I think it's a bit more technical. I guess it depends on the ETF that you're looking into. So probably for thematic ETFs and those that are more custom ETF, maybe the liquidity might not be as much as your S&P 500 and the likes. You want to add anything on that?
Yeah, and I think in general, if you're looking at something that is where the underlying fundamentals are sound, uh, we wouldn't work. I would say that liquidity, yes, is something that is a secondary factor lah. The most important thing is what you buy is something that is good, right? So fundamentally wise is good, or it is based on the long term secular trend. I think that is the bigger consideration. Then of course liquidity, that is something. Yes, it comes. Some ETFs may be more liquid than others, but in general, I would think that most of them are actually fine in terms of liquidity. Yeah.
Okay. I think the next one is on SGX listed ETF. What happens to the ETF that track US counters? Will the volatility be reflected in ETF prices when SGX is closed for the day? You want to take that?
Hold on. Will the volatility be reflected when the in the ETF prices when SGX is closed for the day. Okay, so you usually, yeah, because there's a difference in the timing, right? So if let's say you have been through some big price movement, whether it's on upside or downside, right? Say during the US hours, then following in the session when the Singapore site open, yeah, you might see the price volatilities as well. But of course, it also depends lah, because it's still moving, right? So for example, like look at S&P 500, they have the futures as well, right? So maybe the market for the ETF is not open, but then things are still moving. So maybe the day before during the nighttime, you have a very sharp, say, price rally or a price decline, but things can still change when the Singapore market side opens lah. Yeah.
Maybe just add on to it. I think in short, your volatility of the ETF will also be there, but it's probably not as bad as a single stock itself because of the diversified nature of ETF in general. Of course, the different timing of it will probably affect in terms of how the market will open in terms of the pricing. Any thoughts on Chinese stocks? I don't have. Do you have any on this one?
Chinese stocks, okay. In general, for Chinese stocks, what you can see is that they tend to be more volatile as well. In general, over time, right? Based on what we have seen. So when it comes to the Chinese stock, you do want to also pay attention to your position sizing as well. How much of your capital you want to allocate into Chinese stocks. But of course, you have to have conviction in it lah, before you invest in it. So it shouldn't be like, oh, because I hear from my friends, they're talking about this Chinese stock, Chinese ETF. I think it could be the future and so on, and therefore invest in it. I think it's important to build conviction because when the prices become very volatile, if you don't have the conviction, then you're going to get weak hands, right? Of course, what I'm saying is when the prices come down, like if the prices go up, right, you profit from it. But the problem comes in when the prices come down, and if you don't have conviction in it, then that is where it's very easy to just sell off, right, to try and cut losses. So you want to be careful in terms of the diversification. So I mean, personally for myself, I do have some exposure to some of the Chinese tech names, but they are not the full portfolio. So I also have exposures to the US side. Doesn't have to be US tech. It's a mixture of US tech, non-tech players as well, some of the Singapore names as well. So so that if one part or one market doesn't do well, right, you still have other parts of your portfolio that can actually hold up.
Thank you. The next one is on I think on the Changxin Memory Technologies. I don't think it's listed on Singapore or Hong Kong. Correct me if I'm wrong, Hazel. But I do know that there are specialized memory and semiconductor ETFs in US that have a bit of exposure on that. So,
Yeah, I'm not too sure whether is it. If I'm not wrong, I think they are not yet listed, right? Are they?
so that there is I think after its blockbuster, there was I think it jumped up a lot in their IPO. So I think that's why people.
Oh, okay. I'm not too sure about the which ETF that has the exposure on this lah.
Both,
Yeah.
I think Singapore and Hong Kong don't have, but US, I think some of the specialized memory and semicon ETF would have lah. But then again, because it's so specialized, I would think you want to look at the underlying ETF. What is it holding before you decide you want to.
Yeah.
I know that CXMT you might be a bit hype up about that. Something to take note of. All right. Let me see. Market record high. Would you recommend to buy ETF during market crash? Hold on to cash as king. All right, maybe I think it's about the way I see it is really about how you manage your portfolio. I wouldn't say that you just hold on to cash even though the market is rallying or I think if you wanted to wait for a market crash, you probably be waiting for quite a while, especially in the last 10 years or so, for example, right? And then when it crashed, you'll probably be too afraid to go into because of the sharp decline in it. I guess the idea is really to balance out a bit on that front. So to see what you really want. So which is why I think your slide on I think just now your
Mm.
answers on in terms of how you manage your goal and having that core portfolio is very important. So that's basically something to take note of. You want to add something on that?
Yeah, actually, I share similar sentiments as well. So yes, okay. At the same time, something to add on is that for myself, the way I see it is that I do have a little bit of cash at the sidelines. But I'm not saying that I hold cash only when the markets are high. Along the way, right, some of this cash can be good bullets when the opportunities come. But you don't want to hold just 100% cash, right? Because it means to say that you don't enjoy the upside when the market is at all-time high when it is rallying up. So it has to make sense. Most of the time, most of the money is actually invested in the markets. For a very simple reason, because you want to build wealth, right? And also especially it depends on how passive, how active you want it to be as an investor. Today, if you are more of a passive investor, then you most of the time, most of your capital will be invested already in the market. But holding a little bit of cash at the sideline is just so that when opportunities come, you can actually act on it.
Okay, thanks for that. All right, I think basically the next question is if I missed last week crash of some of the stock, you think I missed the boat? I think that's really what Hazel has been talking about, right? I think even when we started off, I think it's very hard for you to really look at when is the best timing to go into. It's very easy for us to tell you like rotating into say power and cooling now because we think that there's a bottleneck in it, but share price has already gone up, for example, right? So there's always that concern that is it going to come down or is it, I think even the questions that we saw at the start of it, right? Is it too late to buy into
Yeah.
Singapore market, for example? I think that's really not the core focus of looking at things. The way you should look into it is see where the growth driver is going to come in, right? So I think it's not an easy thing to do, right? Like when we talk about, say, Microsoft, for example, or even when we were talking about Intel, I think it's a very difficult challenge to say that we think that this company is going to do well, just especially at the time when the prices are coming down and everything. So it's about that conviction that you have in terms of the business model and where you see growth are coming into, right? So I think that's something that you need to balance out. So the idea is really to look into the markets and see where you think the opportunities are, and I think gradually deploy some of your capital into it. So ETF allows you to do that way more easily because when you invest into it, it's really already a very diversified portfolio in general.
Mm.
So that really helps to ease things out a fair bit. Uh, Hazel, you
Yeah, adding on to that, I think what's important for investor, whether you're looking at ETFs or individual stocks, right? So when you're investing, really, what you should have is really a stock watch list and also ETF watch list lah, that you have built on your brokerage platform. Like in this case, if you're using our platform, right, or even tools like Yahoo Finance and all that, right, they do have the function of having a watch list, and this watch list will come in very handy because when prices come down and you know, oh, this is a good company, like this is a good stock, or this is an ETF that I want to invest in because it gives me exposure to this theme or this sector, this industry, then that's where you can then act swiftly, right? So you wouldn't worry about, okay, missing the boat. But let's say for whatever reason you didn't manage to see the market, maybe, right? Maybe you were busy, you didn't manage to see the market, you miss out the boat. For me, if let's say I miss out on a particular stock or ETF, the price have already rallied up by a lot. Would I chase after the price and buy? My answer is no lah. For myself, I would like to buy when the prices come down cheaper. When it goes back out, I missed it, right? I wouldn't just chase after the prices. So that's the way that I invest for myself.
okay? I think the next one is on tax implications. So in general, I think the invest Singapore is quite a tax-friendly country, but I think investors' country of tax residence may have some, I think, withholding tax and things like that. So probably you want to check in terms of where the ETF's domicile is. You want to add on that?
Yeah, so if you're looking at yeah, that is correct. So I mean, unless you're looking at those that are, Singapore REITs ETF, things like that, then those yeah, there will not be any tax implications lah. Yeah.
Okay, I think I don't have an answer on the allocating one portfolio because it really depends on your objectives. I think it depends on how you want to start. Um,
Yeah, it really depends because it depends. Firstly, it depends on how big your portfolio is. That's one thing. All right. And then, so let's say if I have $10,000 portfolio, then for example, want to buy okay, so if you have a $10,000 portfolio, okay, these days with fractional shares, it is very good because if you don't have fractional shares, well, imagine I just buy one, like we talk about Microsoft, one Microsoft, then it's going to take out already a few $100s, right? But with fractional shares, you can actually do it. So basically myself, okay, I can't tell you how many stocks, how many percentage, and so on, but for myself, a rule of thumb is I do like to keep each single position within maximum 10% lah. In other words, I want to diversify. So I want to make sure that I'm limiting the risk that I can lose for each position. But it's not a hard and fast rule, right? Different people they have their different standards and threshold. For myself, I try to keep it even the bad highest conviction counters ETFs. I generally don't want them to exceed say 10% or so on. Yeah. But really, how much you want to allocate to each position, it depends on your own personal investor appetite yourself.
Yeah, I think it's gonna add a bit on this lah. Basically, I think it depends. Like if you started off with a big chunk of money that you want to invest, that's probably easy. You probably just want to classify how much you want to put into, right? But if you're looking at cash flow, you're getting a big chunk of, say you're a high salaried worker or whatever. So every month you
Mm,
got a big chunk of money that comes in, then you can probably do it this year and how you wanted to allocate it. Personally, I think that at the start of it, I think Hazel just now showed that core portfolio. I think you want to build that up first before you wanted to trade so much. You want to build up your portfolio with companies that have strong structural growth, that can give you dividend,
mm,
that give you that sort of resilience, whether there's a bear market or recession and stuff like that, which means your consumer staples, the likes of your utilities and things like that. So that's how I would see it. So once you've got that stabilized, I think then you can look at things that are more tactical. Right, so that's probably how you can get started. So if you're really not sure, probably the easiest way is to look at the S&P 500 that gives you that diversified in nature in terms of which is where ETF really comes in.
mm.
Right. Okay, I think we've done most of it. Let me just take a look at, yeah. Okay, I don't think we can, I think we passed the time. Do you want to take one more? Or
Okay, one last question, maybe. Anyone that you want to take?
I think it's on the SGX listed ETF. What happens to ETF that track the US counters? Will the
Oh,
volatility? Oh, this is already
I think
done.
we covered already. Yeah.
Okay, right, maybe. Okay, don't have one, I think.
Okay. Okay, I think there's one. What's the cons if one to invest in gold ETF versus physical
Oh,
gold or paper
yeah,
gold?
yeah, I didn't see that. Sorry about that. Uh, I think for ETF Go is really easier because you can
Mm,
just buy and then as compared to physical Go, right? You don't
yeah.
consider how you store it. For paper Go is basically actually a contractual claim linked to a Go. So it depends on the counterparty risk. I think that's more something that you want to look at. So I'll probably look at Go ETF, which is easier. I'll probably look at the
Mm,
annual cost, which is your management expense ratio, which is easier to do so lah. I think for
mm,
paper Go, you probably need to look at account fees, financing,
yeah.
or fees and all that. So those
Mm,
basically the downside too.
yep.
Is that you wanna add anything?
Nope, actually the same as what you've just shared.
If there is any more question, you can write in for us to us, and we'll reply and get back to you guys. All right. Thank you.
Mm.
Yes. Hey, thanks, Hazel, for the.
Thanks, Billy.
All right. Thank you, everyone. Good night. Bye.
Good night, everyone. Bye bye.